Welcome back, everyone. This is Trade Idea Alert Part 2, an even more timely matter. For those of you who are not following along with me on Twitter, then maybe you should, because after I posted my Trade Idea Alert Part 1, which I didn't know was going to be a two-part series, after shortly posting that, I then commented along with it, I don't know why I didn't think of this idea. So if you follow me on Twitter, then you would have been getting this information and this idea, let's call it 18 hours earlier. So with that said, let's get on with it. Yesterday, I discussed with you some potential trade ideas, link an article, around Hurricane Milton. If you wish to fade it, that just sounds ignorant and hubristic. Well, here I am again today offering you another idea. Yes, the idea of fading a Category 4 hurricane barreling towards Tampa seems like an idea. Today is an investigation to see how the Florida-focused property and casualty insurers and reinsurers have reacted to 4 of the worst Florida hurricanes in the last decade. Here are the major hurricanes that I'll be covering today, which made landfall in Florida as Category 3 or higher since 2010. I'll just go through this quickly. Hurricane Matthew in October 2016, Hurricane Irma in September 2017, Hurricane Michael in October of 2018, and Hurricane Ian in September of 2022. It's worthwhile to keep in mind that the period from 2016 to 2018 was particularly active and challenging for Florida in terms of major hurricanes. The 2016 to 2018 period was particularly devastating, while the following years have seen fewer major hurricanes. I know that the Florida insurance and reinsurance game has changed over time, between larger players such as Chubb removing themselves from the market, or the statutory limitations decreasing from 2 years to 1 year for roofing issues. I'm not here to talk about that today. I'm merely looking at the charts to be able to set a precedent for my expectations. Here we go. Hurricane Matthew, a Cat 3, October 7th, 2016. I started the chart a month before the hurricane to show what business as usual looked like to provide us with a baseline. I'll be doing the same in the following examples too. I've also included a chart of the S&P 500 to provide a context to the broader market. Let me zoom in here so we can actually maybe see something, because that would be nice, wouldn't it? All right. So, there we go. On October 6th, they bottomed out, bouncing. By the way, the stocks we'll be discussing are ACIC, these are the ticker symbols, or HCI, UVE, ACIC, and HRTG. On October 6th, they bottomed out, bounced, but then bottomed out again and at a deeper retracement. HCI and UVE double bottomed the first week of November, while ACIC and HRTG bottomed out at that same time, but at a steeper decline than their initial October 6th bottom. HCI, UVE, and HRTG corrected about 20%, while ACIC corrected roughly 30%. You'll notice, though, that by the beginning of 2017, 3 months later, 3 of the 4 stocks were up 15 to 28%. So what am I talking about? The hurricane happened October 7th. So if you can see my mouse, this right here, this drawdown is where it happened. Now, like I said, I started a baseline. So it goes back to September 7th. So for instance, HCI was up 21% from September 7th. But had you bought, and this will be a recurring theme, on the day of the hurricane making landfall, you'd actually be up 40+% with the HCI example. Hurricane Irma, Cat 5 at peak, Cat 3 at landfall, September 10th, 2017. On September 7th, 2017, they bottomed out. Notice that that is 3 days before the hurricane made landfall. They bottomed out and mostly bounced into year end, except HCI, which is why a basket approach to these names isn't the worst way to go about trading them. The stocks corrected roughly 15 to 27%. Yet again, by year end, 3 of the 4 stocks were up from where they initially dropped. Okay, yet again, HCI closed the year end at down 25%. Yet again, that's from the August 10th, because I started a month before the hurricane hit, to show you the baseline of how much. So if you were holding, living life, all fine and dandy, skipping along, and then bam, hurricane, your stock falls, in the case of many of these, or a few of them, 25%. And it's like, oh no, I've lost everything. But then, you buckle down and you hold, and then after a few months, you're up on your position. Not only did you break even, but you were actually up on your position. So, as I noted, the theme being buying when landfall hits, or the days prior to it hitting. In the case of HCI, if you bought then, you would actually be flat on the year. It's dead money, don't get me wrong, and then the S&P was up 10% in that time period, but you weren't down 25%. You were break even. You bought the pre-landfall scare, and then you wrote it out, and then you didn't make any money. In the case of HCI, while yet again a basket approach, you'd be up 10 to 20% on some other names, and then a lot more on other names. HRTG would have pulled back, call it 15%, and then ended up 61%. You bought the dip, you'd be up 70, 80%. Hurricane Michael, Cat 5, at landfall, October 10th, 2018. This time was different. Now let's pause on this image. This time was different. Instead of bottoming before the hurricane made landfall, they didn't bottom until a few days after the fact. Then they proceeded to trade range-bound and muddle along for the remainder of the year, taking a final leg lower in December. The good news, or less bad news, is that if you bought on the landfall date, you'd be only down a couple of percent versus 10 or 20%. Hurricane Ian, Cat 4, September 28th, 2022. That's one hell of a chart. ACIC fell 70%, while HRTG fell 50%. Neither bottomed out until over 2 months later. But here's the kicker. Had you bought the days prior or the day of the hurricane landfall, you would have been up on 2 of the 4 names by year end. It would have been a net positive trade, which would have also outperformed the S&P 500. It wasn't the easiest way to make money, but it was nonetheless a way to make money. Check that out. So I started this chart the day of landfall, which would have been September 28th, is when this chart starts. And had you bought, seeing the other 3 times this play out and say, okay, I'm buying the landfall date, and then you bought it, and then boy howdy, you would have lost, what, in the case of, this is beautiful. In the case of ACIC, you would have bought the landfall, it would have dropped on you by 55% by December. But then by January 1st, 3 months later, you'd be up 60%. So you went from being, so in a 3-month time period, you went from being down 55% to being up 60%. That's volatility right there. Oh boy. And then the S&P was up 3.69%. Incredible. Now, in the case of HRTG, you would have sustained a 45% pullback and then still been down 25%. But yet again, a basketed approach, that's why people take basketed approaches. Equal weighted, so on and so forth. However you want to do it, you do you. Okay, this now brings us to today. Hurricane Milton, Cat 4, Cat 3, question mark, October 9th, 10th, question mark. This is what things look like thus far. Starting back a month, business as usual. Then, oh boy howdy, hurricanes coming. This is what's happened so far. I took that picture today. That's why you see the little bounce. Is it a dead cat bounce? Is it take another leg lower? Time will tell. UVE has already pulled back 20%, and HRTG has pulled back 20% from the September 9th, 2024 levels. Now, with that said, you can actually see that, what is it? I do not know what that, HCI, I believe it is only down 2.17%, but you can see that if I started at a different timeline, the all-time high, let's call it, it's actually down 15 or 20%. But I don't want to be that guy because I didn't do that with any other charts, so I'll just leave that there. It looks to me that so far we're on track with historical precedent, but so is a current Cat 4 hurricane on its way to Tampa, Florida. So with that said, choose your players or don't, that's on you.